name is Karen Jones, and I'm representing the Pengana National Distribution Team today. Welcome to Rhett Kessler, Chief Investment Officer and Fund Manager of the Australian Equities Fund, who will be presenting to you today. Again, we find ourselves in intriguing times. And fortunately for us as investors, Rhett and his team stay incredibly close to what is unfolding always. There are many unknowns again, but I'm sure this session will give you the confidence in the team's carefully selected portfolio of solid, profitable companies. Rhett will present for about 30 minutes, and then we have plenty of time for questions afterwards. Please post your questions via the Q&A box at the bottom of your screens. Rhett, with that, I will hand the session over to you.
Thank you very much, and thank you for the opportunity to be presenting today, and thank you for dialing in. I'm going to start with a bit of an overview. As you know, we always like to have a picture on the front page of our presentation, which is one of the main themes. We've had this inflation picture up for a little while, where we think that the reserve banks around the world are struggling to contain inflation, which has gone from extremely muted for over a decade to a runaway rhinoceros. And it's having a lot of implications, and I'll touch on some of those for a while. In this presentation, I'm going to go through our past performance, our view of where we are in the market, our more recent performance, and then an analysis of the portfolio and how we're positioned. So let's jump into it. There's the disclaimer. There's the team. Yes, it is in descending order of boldness, starting with myself, but the team is in good shape and very, very excited, as I am, about what the future holds. For a long time, it's been remarkably difficult to invest, given our concerns about the rising cost of money and the fact that share prices had not taken that into account. Value is definitely starting to emerge, and you'll hear from the enthusiasm in my voice that we are dusting off a lot of files, and we started to deploy quite a bit of capital. Our investors' needs and our purposes remain the same since inception just over 15 years ago. We think a better way maybe to encapsulate our mandate is to preserve and grow the purchasing power of the funds entrusted to us. And we've done a reasonable job on that. I know last year was a tough year, but since then, before then, we've done a very good job. Since last year, things have returned to normal, and we're hoping that by the end of this year, we'll come back and say last year was an aberration. And I will talk about what happened, but I do want to be upfront about it. And things have certainly returned to normal. In fact, this year, we've managed to generate quite a nice real return in what I think are quite difficult times. And what you're seeing, we're the light blue. What you're seeing is keeping up with the market when it's remarkably strong, and then minimizing the downside and even exceeding in April the upside, giving us a very nice calendar year to date of just under 8%. On a longer term perspective, we continue to stay ahead of this ever-increasing green line, and that green line is a combination of the risk-free rate plus 6%. I must highlight that it has steepened, so it's currently just under 10 is the cumulative annual rate it goes up at. We know we've come back down from our high, and we have some work to get back there, but we're working hard, and we're reasonably confident that we'll get there and continue to get there over the medium to longer term. So where are we? And these are the bits that a lot of people have asked me. Where do we think inflation is, and what is the outlook for both inflation and interest rates? This is our view. We think inflation has definitely percolated through the global economy. It's popping up everywhere. If you've got any kids with a HEX bill, they're suddenly realizing that the bill's going up at 7% from the 1st of July, and suddenly it's not a free, low inflation debt anymore. It's popping up in wages, It's popping up in costs everywhere. It's popping up in rents, etc. And we think its impact will be enduring, mainly because once inflation gets into the system, it's quite hard to get out. And really, it's a combination of stimulus-induced demand, very low cost of money, huge quantitative easing, etc., etc., impacting on an environment where you've had all kinds of constraints over supply chains. You've had Ukraine-Russian war, you've had COVID-induced absenteeism, and etc., etc. And so 101 is when too much money chases too little goods and services, you get inflation. Now, there's no doubt that last year was a perfect storm, and so inflation was very high. Media would have it that if you read the media, that inflation's peaked and it's going to absolutely, fall to very low levels. We don't have that view. We think it has peaked, and as you comp these very high numbers, the actual numbers will come off. But we think we're going to remain at an elevated level. And can I just say that as long as interest rates are less than 4% when inflation is above 5%, that's still considered stimulatory. And we think interest rates have some way to go. So we think on the outlook there will be further rate increases, albeit not as small and as rapid as we've seen. And we see low likelihood of rate relief medium term. So higher rates for a little while. To put in perspective, interest rates were lowered to emergency settings at 0.1. I think that it's only reasonable to expect that 4%, maybe a little bit higher, given where inflation is a reasonable level. And this brings me to my next point, which the cheap money party is definitely over. Central banks are lifting rates. They're simultaneously, I've never seen this before, but they're simultaneously withdrawing QE. And this has implications not just for your base rates, but for your credit spreads. The amount of uncertainty around the impact of these higher interest rates, as we've seen in regional US banks, is spilling over globally. And so everyone's demanding a reasonable return for their money and the risks out there. And so the amount people charge over and above what the base rates are has been expanding, and we expect that'll stay elevated. I guess the conundrum is the consumer has been remarkably resilient, and for how much longer? We have an investment in super retail, quite a large one. We're consistently joking with management that the consumer cliff keeps getting postponed. It was going to be sometime around June last year, and every 3 months it gets postponed. I suspect we're almost there. And certainly when fixed rate mortgages come off, and with the amount of immigrants coming in, the employment might not be as robust, and we'll start to see signs of weakening. But we're not talking anything catastrophic. And I will go through a number of the reasons why we think Australia is exceptionally well placed. There's a massive conundrum, and this is the one that we wrestle with every day, about the tension between unaffordable cost of housing, residential housing, versus a shortage of availability and the cost of actually building and the timelines to build. And this has been exaggerated by, you remember the Royal Commission, when a whole lot of funding towards apartments got withdrawn by the banks tightening up. You then had COVID, where a ton of inventory was placed back into the residential market as tourism dried up and Airbnb was flipped into longer term residential. And you had foreign students and foreign workers leaving en masse, creating a surplus, temporary surplus of accommodation. Those have all flipped, and we're getting very sharp immigration. Tourists are back. Population growth has been quite strong, and you're seeing a real tension in this area. We think we have some ideas on how to make money out of it, but it's certainly providing a floor to the elephant in the room, which is how far do house prices fall. But more on that later. One of the big risks in the market for anybody trying to invest and for any company trying to run an efficient system or an efficient business is forecasting risk. Whether you're forecasting sales, supply chains, consumer demand remains remarkably high. You have to go back to 2019 to try and find a normal year. And then when you're trying to average, you've got an interest rate inflection point in the middle of that. Imagine trying to work out how many pairs of shoes you're going to sell for a soccer season this year, given the difference since you had a normal difference in time since you had a normal year. And as I mentioned earlier, my enthusiasm is that valuations have really rebased, and we're having quite a bit of fun. So there have been real opportunities to deploy cash. This slide I showed at a webinar a little while ago. We kept it specifically busy. Really, you can use the colors as a guide. You remember back in June 2021, we spoke a lot about how interest rates were really low. And the last movement in interest rates across all the central banks in all the different countries was predominantly, overwhelmingly a cut. And you had very, very low interest rates, and you had very negative real interest rates. October 22 was the last one we showed where everyone had flipped to a hike. I suppose the speed of the hikes surprised even us, and the speed of the inflation creep. And so you've got a current situation, May 2023, where the last movement has been a hike, yet inflation has kept ahead of the hikes. And so you've got still very negative real interest rates around. And that is the conundrum we face. Can they now continue to lift interest rates? And what impact will that have on the economy? So my favorite slide, I mean, it's a very doom and gloom picture, but you can see that interest rates, if this is a proxy for the long-term cost of money, global cost of money, the US 10-year Treasury bills, you can see that we've had an incredible period of ever declining interest rates since the 90s. And this is the first time we've seen a significant reversal in that dynamic. And funny things start to happen when you have interest rates going down for that long. And then when you don't have that tailwind and its impact on long duration assets, that creates its own tension. And then when the cost of money starts going up, rather than just even staying flat, that creates real pain. And I suspect that what we're seeing with the HEC students, what we're seeing with virtually every real estate, particularly around commercial syndicate, that pain will start to be very, very visible. And we've seen quite a bit of it come out. Remember, it was only 2 years ago when 60 to 70% of long duration bonds were trading at negative yields, nominal yields, not real yields. And you can imagine who's holding all that pain. All right, so Australia. Got a couple of slides. I'm going to go through them very, very quickly. This is just sovereign debt rating. Australia sits at the top of the table. As a percentage, central general government debt as a percentage of GDP, we're very well placed compared to the rest of the Western world. On most economic scores, we rank very, very highly. And on almost every investment benchmark, we've got very, very good scores. Yes, we may think that we've got, depending on your views, a good government, bad state government, etc. But overall, decisions taken over the last few decades have been very, very good economically, as well as within a very fortuitous environment. A lot of people say, Reddit, Australia's all about mining. This is a really interesting chart. Yeah, mining has been very strong. It's the thick blue line. But as a percentage of the total economy, it's only 11%. Powerful, but only 11%. So we've got a well-diversified economy. This is probably the most powerful. If you think about what GDP is really population times productivity is equal to GDP. And we've got the strongest underlying population growth of the Western countries. So we're quite well placed, as well as one of the best demographics in that our average age is 36 versus everybody else. We know Japan's in trouble at 48. States is only slightly higher, but everybody else is higher. This may come as a surprise to a lot of people, but Australia is also one of the wealthiest countries per capita in the world. I think we compete mainly with Switzerland, but a very, very wealthy per capita and very, very homogenous demographics compared to other countries. I love this chart because it shows how well placed we are to. This is, well over a third of the world's population is in this zone, and we have trade agreements. I suspect that post-June we're going to see physical examples of the tourists as Australia goes back on the acceptable lists for tourism from China. We're already seeing very strong inbound tourism and foreign students. I suspect that will accelerate and really doing exceptionally well. I know a lot of this is driven by mining volumes, mainly iron ore, coal, and LNG, but looking quite good. It's hard not to get excited about the wealth coming into the country as every day goes by. I often say that our trade balance is at all-time highs, and we've got the trifecta of volume, both from metal ore, from coal and LNG. We've got price, and we've got a very low currency. So every day that goes past, our coffers continue to get bumped up. Unemployment's really low. I suspect this will reverse quite a bit as foreign students and foreign workers come back. It's about 50,000 coming in a week, and that's going to be both good and bad. That'll solve some of the employment issues we have with not enough people. It'll jack up the search for residential accommodation, but certainly strong population growth and wages growth at the moment highlights why I think inflation will stay high for a while. All right, we're almost at the end of the macro stuff, and then I'll get into the fund stock stuff. But this is really all about overseas net migration, and you can see there in per state, it's pretty well shared amongst all the states. But you can see what was created by COVID and how fast it's bounced back. And this has really weird implications for some companies in our suite. One of them being, health insurance. If you want to come into this country, you want to apply for a visa as either a student or a worker, you have to buy private health insurance from either NIB, Medibank, or any of the other providers. If you're a student, you have to buy 3 years worth before you actually can get your visa. And they used to have about 250,000 of these students. It dropped down to mid-COVID, down to about 20 or 30,000. And it's bouncing up by 50,000 a week. So very, very strong profit run there. Look, the elephant in the room is definitely what happens to house prices, particularly after these peaks that we've seen. Sorry, not that one, this one over here. It's supposed to be up in the top, so sorry, that's why I went to the left. But house prices have recovered, were very, very strong, particularly during the latter part of COVID. And then as interest rates went up, they fell. We're starting to see them bottom. The latest indication is they're actually not falling anymore. But that's only one or 2 weeks worth of data. And it's really been underpinned by vacancy rates are very, very low. And so everybody's looking for accommodation. And I spoke about that earlier. And also, this is the impact of the stimulus. This is your savings rate. You can see it went through the roof as we went into COVID, and it's slowly being eroded. These are quite dire forecasts. These are all forecast. We haven't seen real evidence of that, but the savings rate has definitely reversed from being way above to below in the last couple of years. Okay, enough macro stuff. I've used up quite a bit of time. Now all about the actual stocks. That is the portfolio. So quick overview, mostly defensive because of the forecast risk, and very exciting that there are a lot of stocks in there. that we're happy with. NIB and Medibank is probably our single biggest aggregation on two stocks for one factor, which is private health insurance. I'll talk about that in a sec. But you can see it's quite a boring defensive portfolio at 45 or 46%. Financials up at 21. Consumer discretionary quite high at 10. That's not because we think the consumer is going to shoot the lights out. It's just that the stocks have been so badly sold off that we think we can find in great value there for sensational retailers. Resources really BHP, which is the lowest cost producer of iron ore, and we can get a really nice after-tax cash earnings yield, even at a much lower iron ore price. And then we've got Evolution Mining, which we think will be the lowest cost gold factory, and we like gold, and we're getting quite a nice after-tax cash earnings yield there. We have been tearing up a bit of money in options, got 0.2%, and I'm happy to be tearing up the money in options because it means the rest of the portfolio is doing okay. Cash levels have actually dropped from that level. They were 13.3 2 weeks ago. They're now just at 12%. So we've applied quite a bit of money. People ask me, Rhett, so what do you think the portfolio is going to do for the next year? The best way I can think about it is, I don't know what the markets are going to do, but we're managing to buy this portfolio at a 7.1% after-tax cash earnings yield. So we're thinking about that just for a second. I know many of you have heard this, but the after-tax cash earnings yield for us is if we owned 100% of these companies, we ask ourselves at the end of a year, how much could we come in, scrape off, put in our pocket, walk away with in cash, so we don't impact the business. So a real surplus cash flow as a percentage of what we're paying for the shares. And at the moment, it's an average of 7.1%, weighted average. That's very high. We also think most of the companies have about a 5% surplus on their balance sheets, some quite a bit more, some a little bit less. But that means that as we get through this volatile period, they're either going to spend their money on buying more earnings or give it back to us. And so 7 plus 5 gives us 12. And that's comfortably above our risk-free rate plus 6%. That's how we manage the business. Remember, my job is to create a well-diversified, ever-growing annuity stream of companies. And we think we've done that quite well. So last year was a challenging year. As I mentioned earlier, it was the worst year we've had as a fund. And two things really went wrong. First of all, we were very light in resources and energy stocks. Never been more tempted to change my spots in that way, but we didn't, and we won't change our investment philosophy. We find energy and resource stocks hard to predict, the input prices, and we find it extremely difficult to predict the cash flows given the differences between maintenance capex and growth capex. Remember, if you've got an oil well, you have to constantly go out and explore and find new oil wells to replace them. It's not like an industrial company. We've done a fortune of work on some companies, we can't get them. And then from an absolute perspective, I think we made a few mistakes. They're painful mistakes, but we have fixed them. So we were too concentrated in diversified financials. We took quite a bit of money off the table in those areas after the January results. So we didn't panic. We waited for their share prices to bounce on the back of their performances, and we took quite a bit of money off. Ryman Healthcare has been a problem child. The model is not broken. We think management didn't execute, and we're in constant discussions. The board has replaced management, and we're in constant discussions with management. There's a lot of value to be unlocked there. And then finally, Evolution Mining had a misstep with its Red Lake in Canada. I've been there, I visited the mine. I'm confident that they can turn it around. And as you know, everyone laughs at me when I say I'm very confident there is gold there. And they didn't buy a pup, but we think this is going to be a great asset. It's bounced substantially. Some of it on the back of the gold price, some of it on the back of the execution, but we think there's still quite a bit of value to be unlocked there. So we've admitted our mistakes. We know what they are. We fixed them, and we think that we're on the road to recovery. That is just a very quick illustration of the skew towards the performance by materials and energy. We can buy those. So it's not a real excuse. It's just it's not within our wheelhouse to take a punt on those volatile sectors. So what I've got for the next 5 minutes is just to talk about each of the sectors that we're in and the underlying individual stocks. This is the bit I love, and hopefully most of the questions will be on this, but that's really up to you. So discretionary retail at 8%. We do have another 2% in James Hardie, but these are the actual domestic retailers. So we don't think the consumer is going to shoot the lights out, but we do think that these stocks are just too cheap and they're solid, sustainable earnings. So if we have a look at super retail as an example, these are really two very strong brands, and then Macpac is the third strong brand. Super cheap auto is 40 cents in the dollar, just over. Rebel's just under 40 cents. We can buy them currently on a 14% after-tax cash earnings yield. And if earnings fall by more than 30% next year, we're still getting 8%. They're very good businesses. The company's debt-free and has about a quarter of the market cap sitting in cash on its balance sheet, which we expect to get back after the financial year end. And we think management have done an excellent job and been an upgrade. The biggest sector by far is healthcare. I've already spoken about Medibank and NIB, but just to add some additional points on it, there's no doubt in our minds it acts as a hedge against higher interest rates, because we get a really nice return for the first time in a decade on the shareholder float and the policyholders floats. Importantly, you've got a big turnaround in non-resident health insurance. In the case of NIB, they also have a travel insurance business, which has gone from a large negative to a big positive. And they're also consolidating a new industry, which is the NDIS plan management industry. And we think they're going to have great success in that. CSL just spent a week in Europe looking at their assets. They've spent over $2 billion investing in building capacity. They've spent over $5 billion in buying another company focusing on iron deficiency. The synopsis of my view is there's a tsunami of profit coming down the line for CSL, and that's why it's our single largest holding in the portfolio at almost 8%. And then we've got ResMed, which went from the leading member of a duopoly or oligopoly, and it's now a monopoly business in sleep apnea, as its competitor blew itself up with some very big issues with the FDA and the requirement for some big recalls. So really at the quality end, we're very comfortable with our healthcare exposure. I will say ResMed's a bit expensive, but we think that'll catch up. Underlying earnings will catch up very quickly. And it's the one stock in our portfolio that doesn't generate a 6% after-tax cash earnings yield. I am going to flick through this just so you know, for CSL, it's really a plasma fractionation business. The iron deficiency business, which is V4, is now 15%. And then the vaccines, royalties, R&D is really 10%. Really high quality business. And banks, I think everyone will find interesting. We have 13% of the portfolio as at the beginning of the month. We've just added another bank in ANZ. We think we've got the country's best business bank, best home loan bank, and best infrastructure bank. NAB was looking a bit expensive. We did take quite a bit of money off both NAB and CBA, and we've reloaded on those following the recent hiccup at the results where they came back quite strongly. The reason we've added ANZ is we think it's got the country's best institutional bank. Now that you actually have to, you can't just hand out your flyer and people give you money. You actually have to go to a bank and get it with a change in the cost of money. ANZ institutional bank is 40 cents in the dollar. You can buy it at 1 times book value, and you can buy it on a really nice, about 8% after tax cash earnings yield. So we're very, very comfortable with that holding. Telstra, we've held it for a long time. It's been a really good performer. It's just slipped out of the top position, which it's handed over to CSL. So we have about 7%. It pays its own way with an 8%, really nice after-tax cash earnings yield, really chunky dividend, fully franked. But more importantly, it has 65 cents in the dollar for your mobile phone business. It's the leader, very sticky business. We've just noted they're going to put up, it's a real inflation protector. They're going to put in their rates up by 7% for their plans, as well as the recurring NBN stream has gone up by 7% at the top line, mainly fixed costs, massive operational leverage, and we think that'll come through quite strongly. I must say, though, Telstra has been a great performer, and it has started to get out of the ridiculously cheap into the moderately fairly valued space. Woolworths and Amcor, it's just literally your toilet paper and toothpaste type businesses. Very comfortable holding those. We've got 8%, and I'll take any questions on that. And then finally, I just want to finish off on cash, puts, and energy. Puts, we like the downside protection. Cost of puts are getting cheap again, so we may buy some more of those. We used to have rising cash levels. That is old, so we had built up our cash, and we've had a lot of enthusiasm about deploying some of that money. Some of our new holdings have been, we bought a bucket load more of NIB. We started a new holding in Metcash and a new holding in ANZ. So we've been deploying quite a bit of cash. And the reason we aren't in oil and energy stocks, although I think the temptation to be in those has never been bigger, is because our fundamental belief is that if we don't know, we don't play. And so forecast error risk is exceptionally high, given the variabilities in those. We've done an enormous amount of work on Woodside and Santos, trying to see if it could be a BHP lookalike, we're lowest cost producer and can still make a decent after-tax cash earnings yield at these prices. Didn't meet our requirements, and we held our discipline. So on that note, we are very excited about our track record and the way it's being rebuilt, particularly of late. And we're pretty excited about the outlook. So I'll now, Karen, I think I'll hand it back to you for questions.
Excellent. Thanks, Rhett. As comprehensive as usual. We do have a few questions that have come in. The first one is actually a macro question, and it's something you have touched on often. I think it's a little bit of a question that you find quite fearful around stagflation. So, do you believe stagflation is a likely and realistic scenario, given the persistent higher inflation faced and the potential growth impact?
Yeah. So first of all, I hope not. And, there was a time when we were worried that with the Reserve Bank governor in Australia misreading the room and doing a lunch and losing political strength, that he would make bad decisions, because you make bad decisions from positions of weakness. But the recent hike in interest rates means that they're back on track. In Australia, I don't think we're going to see stagflation because we've got strong population growth, and we keep refilling our coffers every time, every week that goes past with commodity prices and the currency where they are. Europe and the States worries me a bit, and demographics of Europe worries me a bit. But I was really worried about how we'd manage this change. Reserve banks have done very well, so who knows? But I'd say the chances of stagflation are much lower now than they were maybe a year ago.
Excellent. We'll keep our fingers crossed, that's for sure. Another pretty close to another macro question, I guess we can frame it as that, is that's come in. Government debt as a percentage of GDP is low, but personal debt, particularly property debt, is high. To what extent is this a concern, and how does it influence your thinking?
Yeah, so I think the devil's in the detail. There are two factors that change personal debt, and I'm assuming the question's about Australia. I don't really know debt levels anywhere else. But domestically, we've done a lot of work, and a couple of things we've discovered. First of all, the bifurcation we're calling out between the haves and the have-nots has never been bigger. And we're not talking about the rich and the poor here. We're talking about those who have liquidity and those who don't have liquidity. So what we've noticed is that there's a really big group of people who have cashed up and have cash waiting to take advantage of any opportunities, and it's non-trivial, it's massive. And on the other side of the scale, we've got people who have got themselves into asset rich but cash flow poor positions with high costs and high leverage. And we think there's enough cash from the one side to offset the needs of the other side, except there'll be a big transfer of value. And the way you can find this is if you just have a look at offset accounts. So Australia is fairly unique globally in that they have this thing called offset accounts. It's bizarre. So you actually have a massive, as you guys know, you have mortgages, but against it you have offset accounts. So you've got full liquidity and no cost for the underlying debt because you've got enough cash on, and you can access that pretty quickly. So a lot of the stats that are shown is without those offset accounts, so you don't have a sense of how much of it. Just in Westpac, it was about $50 billion sitting in offset accounts. And then the third thing from the debt is always excluded superannuation balances because it's in a separate vehicle and separate entities. And that store of wealth creates quite a bit of defense against leverage. So I think it's pretty much a barbell issue with the people who are over leveraged and have too much debt. But I think the other side of the barbell will take care of it. It won't be pleasant for the one side, obviously, but I think there's enough cash to go around.
Thanks, Rhett. Sticking with property, another question that's come through, and it's quite a big question, so I don't know how you'll be able to answer it succinctly, but it's also on the property side, but more related to commercial, industrial, and office property. How do you see the future or the immediate future of that space?
Yeah, so when the tree gets shaken really hard, you expect lots of things to fall out of it. We've had a few, but we're puzzled. So we're still looking up in the tree waiting for things to fall. And one of the areas that have been shaken really hard is commercial real estate. I don't include industrial in that, but I'm talking about office. So you've had the triple whammy of cost of money going up. So the ability to leverage for extra returns is a problem. You've had vacancies go up because of work from home, underlying vacancies. And I know it's a bifurcated market where, the premium's fine, but everything else isn't. And then you've also had valuations uncertainty. So we've got a couple of big properties that are on the market and they're working through due diligence. Even the companies selling them have said they'll be 10 to 15% below book value. I think that's optimistic. So with cap rates where they are and interest rates where they are, it's very hard to see how you make running yields of FFOs work. So we think there's a rebase coming in that area. If I turn my attention to industrial, there's a wall of money hunting down industrial. Not a week goes past where I'm not approached by a syndicate, in personal capacity, or one of the big companies in the property sector tell you that they're allocating another $1 billion into industrial property development. And I know we're underserviced and I know it's a global thing, but the ability to meet demand by putting up a shed, the timeline's not a big one. Supply can come on very quickly. So we're very cautious on we're scared of office, and we're enjoying industrial, though we don't have any exposure to it, but we're enjoying the metrics around that. Retail and residential, I think, are fine. So maybe if I summarize it that way.
Okay, thank you. You touched on migration before and the benefits to the health insurers. Are there any other sectors in the market that would benefit from a higher migration?
Yeah.
Higher migration levels.
Absolutely. And sorry, I should have made that point in the portfolio. It's very much geared towards that. So if you think about a Woolworths, a Telstra, any of the banks, very, very exposed, Metcash, very, very exposed in a positive sense to that. The one area that we understand, so maybe a Mirvac or a Stockland with their master plan communities or their apartment buildings would be quite well predisposed to that. The problem with the Mirvac is they have 50 cents in the dollar exposed to commercial real estate, and typically migrants, when they come in, it takes them about 2 years before they're in a position to buy rather than rent. So I should also caution, it will also bring down wage prices and should take some of the heat out of the wage or availability of labour conundrum. But I am a little concerned about the impact it'll have on social tensions. When this amount of more people coming in, trying to get rental accommodation, squeezing out people who've been trying for a long time, taking jobs, etc. I suspect there will be some social tension around this. So that's a broad base.
Yeah. Okay, so we'll move to a little bit of stock-specific questions in the time that we've got left. And interestingly enough, the first question read is about a stock that you don't hold, being Cochlear. Someone's just asked why you don't hold Cochlear.
Geez, everybody wants to own Cochlear, myself included. It's one of those real feel-good, credible solution to an issue. I don't think there'll ever be an issue around demand. They certainly are the leaders in bionic ears, and an extremely well-run company. If you think that ResMed's expensive Cochlear is off the charts, about 50% more expensive, and always has been. So we watch it jealously and covetously, but there's absolutely nothing wrong with the company except for the price. And it's like Fisher-Paykel. They just are too expensive, like by a severe factor.
Okay. Now, you made the comment that you like gold. What's the investment thesis in the current environment?
All right. So given that we've been predicting inflation for some time, and for a while we were wrong until we were too right, we think that gold is a store of value. However, if you hold gold, physical gold, the only way you can feed yourself is if you take a heavy piece of gold and you hit someone who's holding a sandwich on the head with it and take his sandwich. You can't eat it in any way. So it doesn't really give you anything. So what we thought of a better way is if the cost of manufacturing gold continues to go up, and therefore the price of gold continues to go up, and we can find the lowest cost gold factory, then we can harvest a really good return out of selling the gold to people who want to hold it or underpin central banks and the jewelry market and the catalyst market. So that's been our play. We did have a bit of a stumble last year when we bought a gold company that we thought was the lowest cost producer, and their misstep in Canada changed our view on that, but only temporarily. We didn't panic. We held on to it, and the operational excellence is coming through now, and the value starting to emerge, in spades. So that's the idea. We want a well-diversified collection of annuity streams or gold mines or gold factories in highly regulated, stable democracies, so Canada and Australia. And it's quite difficult to find those. If you go to the States, even the big US companies have big offshore mines, and so there's a few in Australia. We've chosen Evolution.
Excellent. We can't finish off today's session without providing people with a little bit of an opportunity perhaps going forward? You might be sharing a secret, I'm not sure, but you've increased your holding in NIB. You've bought recently into Metcash and ANZ. Is there any other stock that you're prepared to give a hint about that might be the next step to use up a little bit more cash in the portfolio?
Look, there's always, we're pouring over a batch of companies. For instance, Elders, we've never owned it. Management have done an excellent job in building the underlying earnings base, extremely seasonal and affected by seasonal factors. The after-tax cash earnings yield looks interesting. We've reopened the file on Santos. We'd love to own car sales. Interestingly, JB Hi-Fi starts looking really interesting again, not far from this price. There's, I'm specifically mentioning, a range of companies. We're not close to buying them. The one that really intrigues me, I guess, is IAG. Has a massive shareholders float. If anyone's reinsured their house or their car lately, and the 20% increase in premiums, along with the rest of the industry, so there's nowhere to go, certainly drops down to the bottom line and jacks up earnings. So, if I was really pushed into a corner, I'd say, a general insurer that demonstrates the core capability of getting their documentation right, which IAG needs some repair, and then demonstrating that they can manage the change in risks due to climate change appropriately. And that's one we're doing a lot of work on.
Okay, you heard it here first.
Oh, yeah.
Maybe not.
I'm vague, yeah.
Now, Rhett,
but I do think that the fund is the right place to put your money rather than individual stocks, right? So
yeah. Actually, it's interesting you should say that, because I was just about to say, in many of the meetings that we've done together with our clients, you've often mentioned your mum and your dad and how wise they were and are probably. What would you be saying to them now about investing in Australian equities and particularly into your fund?
To my late folks. So what I'd be saying to them is, I've won a lottery ticket to end up in this country because of the quality of life and the very strong tailwinds behind wealth creation and quality or standard of living in this country. And finding smart, well-run, conservatively run, good balance sheet companies that will just, continue to prosper in this prosperous country is probably the way to go. And we're loaded up to the hilt. Well, not quite to the hilt yet because we've still got 12% in cash, but we've loaded up to the hilt on those and taken advantage of people chasing, fancy valuations. We've stayed away from those. So we think rationality's returned, and this is the time to live off cash flows while they grow their earnings.
Excellent. Well, that is all we have time for today. So thank you so much, Rhett. I think you've given everybody who's tuned in today, which has been a lot of people, quite a deal of comfort, and you have always taken your fiduciary responsibilities very, very seriously. And now I believe there's absolutely no exception to that. We haven't been able to get to all of the questions that have been submitted, but please be assured that we will respond to you. Your state representative will ensure this happens. Also, Rhett, he does make himself very available for questions at all times. So please don't wait for the next formal update if something is on your mind. We are hosting a webinar this Thursday morning at 10 a.m. for the Pengana Private Equity Trust, our listed vehicle, PE1. This is always, as well, an excellent update. So if you'd like to RSVP, you can do that via the Pengana website, and you can tune into that on Thursday morning. On behalf of Rhett and his team, thank you so much for your time today. Enjoy the afternoon and take care. Thank you.